Good morning, everyone. I'm Vince Lancy, and this is the Gold Fix Market Rundown. Today, we're going to review CPI, and we're going to tell you why it was worse than it looked. There's the front page. Lower left-hand side, we're going to be going through that post, and I'll be elaborating on it a little bit more. There's the rest of the homepage. And let's do the markets. 10-year yields are down 3 at 425. The dollar is 97.74, down 30. The S&P 500 is 64.57, up 12. VIX is 14.56, down 18 basis points. Gold is up 12 at 33.60. Silver is up 64 at 38.52, leading the whole complex. Copper, 449, up a penny. WTI down 30 cents. Nat gas up a penny. Bitcoin up 600 and change at 120 spot 700. Ethereum remains the crypto king right now. 46.83, up 93. Palladium 11.33, up almost 5. Trailing, or tracking, I should say, silver. And platinum up 7 and change at 13.47. So much for that being temporary. Gold, silver down, solid, below 89.5. You have to be long silver, not gold. Why do I not listen to myself? Okay. And grains are up, soybean leading the pack. Okay. We sent out a post this morning, awkwardly titled CPI was bad, inflation bakes in, and the Fed should not cut. Okay, but it's a significant post because when we're looking at banks' analysis afterwards, Scotiabank said something that reminded us of something that we were saying and thinking and looking at yesterday with regards to inflation, CPI, core, and super core. And so we broke that down and wrote it up this morning, and we're going to do more. But let's get through the reality of it. U.S. core CPI rose 0.32%, 32 basis points month over month in July, the highest since January, with a 3.94 seasonally adjusted annual rate, according to Scotiabank and everyone else who's watching. Services inflation, that's key, remained strong at 0.48%, and goods prices climbed 0.21%, signaling a possible tariff-driven rebound. Possible is me being gentle. It's a tariff-driven rebound. It could be temporary, I don't know. The breadth of increases also widened, so the inflation broadened to a broader basket, raising concerns that inflation is becoming embedded by us. Data quality issues persist due to rising imputed figures. Scotiabank says, quote, nothing in here says cut. Warning the Fed faces a higher inflation floor and limited policy success. Just to add a little bit more to this, because we're going to do a follow-up later on, like a podcast, the Fed's rate hikes have failed to, I mean, I'm not being hyperbolic here. The Fed's rate hikes have failed to cool domestic services inflation meaningfully, which remains high due to entrenched wage gains from union contracts and cost of living adjustments. Goods inflation, muted by oil releases, SPR, during Biden's administration, is now set to return as tariffs bite. Now, right now, the tariffs are being passed through. I mean, not passed through, they're being absorbed, right? Zero Hedge will tell you that, and they're right. But, you know, some things are not going to be passed through on, and it's usually the stuff that you need to buy. This combination of sticky services inflation that was never properly crushed, I'll say it again. It was never properly dealt with the potentiality or the emerging goods inflation going back up is bad. It makes it harder. The structural floor of inflation is raising. And it makes it harder to push prices lower without severe job losses. So the whole balance between full employment and inflation, well, if you fight inflation, you get stagflation, right? Okay. So it leaves the Fed with limited ability to restore, I'm being kind, limited ability to restore pre-2022 price stability. Now, the full analysis is in the premium post titled CPI was bad, the Fed should not cut. Now, later on, we're going to go through more of this and tie it back to something we saw in 2022 and how it actually played out, unfortunately, the way we saw it in 2022. And that was this. When the Fed raises rates, I'll just give you very quickly. The Fed raises rates, it's supposed to help control inflation. Well, there's two types of inflation. There's goods and services. There's the stuff you buy, and there's people you pay to deliver it, right? Services and goods. Well, if you look at those two inflations, when the Fed raises rates, services inflation should be the one they have the most effect on because we import everything now. Services inflation is the stuff that you pay for locally. It's the guy who hangs the drywall. It's the cost of refinancing a house. It's the manicure that you get. Okay? It's the service charge on your credit card. When the Fed raises rates, it's supposed to control that inflation quicker, but it's not. And there's reasons for that. We'll go into that into the podcast. Instead, all during the decrease in inflation that we had, services inflation stayed sticky, but goods inflation dropped. Now, how does the Fed raising rates keep the price of goods overseas coming to us from going up in price? It doesn't. If you have to buy eggs, you're going to buy them at whatever price. Thankfully, we don't import eggs. The reason goods inflation went down during that period, during the middle of Biden through now, is because we released SPR oil. If you get oil down in price, you can artificially drop, not artificially, but you drop the price of goods. They're made with oil. They use oil to transport them. And so our goods inflation was, let's just say our goods inflation was manipulated lower, tamped down. And our services inflation, we're struggling with. I want to go into more detail, covering core, super core, and the whole path that we saw back in 22, as actually alerted to. We were alerted to it from something that Zoltan Pozar read, and so we went, all right, let's pay attention to that. So anyway, that's it. Again, that full analysis is in the premium post. CPI was bad. The Fed should not cut, and it's our interpretation of a flash report by Scotiabank. Related posts, more gold will go to Asia. If there's tariffs, Goldfix PM, more gold will go to Asia video, CPI prep, and special founders CPI prep. Coming soon, today, tomorrow, the next day, South Africa wants to back a currency with critical minerals, and we say why it's idiotic. We want them to do it. U.S. Treasury deficit grows in July. Zero Hedge did a nice premium post on that, and we want to break it down a little bit because tariffs aren't enough anymore. Let's put it that way. And we have a permanent inflation problem now. That's alluding to what I'm talking about a minute ago. Data on deck today is, I think, speakers today, right? Yeah, Fed speakers. Tomorrow is PPI, which, although not as glamorous as CPI for attention, can be very important. And then Friday, we have retail sales. So it's a big week for data in general. Let's go to the markets. Here, I had a little fun today with my silver chart. Okay. Let's hide that only for a second. Let's start with gold and get it over with. I hate gold. I hate it now. When you have a good idea and you don't make any money, it's really, really annoying. Okay. Here's gold. There's the trading range. There's the three lines, the two lines. We're in the middle of the range. That's the 50-day moving average. It's going nowhere. And that's it. Now, I really thought we were done. Like, after this day, when it opened, I said, okay, this is over. They're going to push it. I don't think, I'll give you the tape. The bullion banks are operating normally. They're selling, but they're not letting it drop anymore. Either that's because they've changed their perspective on risk, their legacy risk is too big, or they have buying underneath. I don't know which it is, but it looks good. Now, silver. Okay, this is it's phenomenal. I was watching the markets last night, right after the tariff debacle, and I looked at gold and silver, and it had a bounce, and I said, okay, it's a dead cat bounce. Maybe we're going to have another sell off. I don't know. And then the CPI came out, and gold looked like it wanted to sell off, but didn't. That was my perception. And silver, really didn't do much. And then I looked at the CPI data, and I said, this really kind of sucks. Like, why does everyone think Powell's going to cut? He might not cut. He might wait another month. He might. And then, 4 or 5 in the morning, I looked at the markets and I went, oh, gold and silver are up. With the dollar, a little weaker, bond yields snapping back a little bit, and stocks up but lukewarm. You look at that again, and I said, oh, the market is looking at the CPI as either stagflationary or recessionary, I had said. And the stock market acted like it was recessionary. Oh, inflation's not that bad. The Fed can cut, and stocks rallied. But the commodities said, yeah, maybe they're going to cut. Maybe they're not going to cut. Let's buy silver. It's lovely. So this is, I believe, the market is trying to figure out if the stagflation or the recession thing is what's going to drive the Fed. I think, I'm not married to it, but I think the stagflation thing, I think Scotiabank is right. I think they have no business cutting right now. And I think the floor has been raised on inflation. Anyway, so that's all ran through my head when I said, look at that, silver's up 50 cents. I'm like, oh, maybe I'm not the only one who read the report that way. Anyway, so that's it. That's my level. Above this, I want to know what happens when it trades $40, but I don't think 40 is going to hold. I don't think 42 is going to hold. I don't think 50 is going to hold. But that's over a 6-month time frame or more. But I'll tell you, this is not the old silver. This is the new silver. In fact, if we get above here, I don't want to get your hopes up. If we get above here, 39, 30, so call it, yeah, $42. $42 is my knock on wood target if we get above the recent high of 39.47 and change. I'm Vince. Have a great day.